How to turn a small account into a bigger one using negative risk to reward. Focus on high probability, not huge wins. In this strategy, the goal isn't to chase massive profits per trade, but to consistently win more trades than you lose. By focusing on high probability setups with a slightly negative risk to reward ratio, you aim for frequent small wins that compound over time, rather than risking large losses for big wins. Consistency is key. Even though you're risking more than you might gain per trade, your strategy has a higher win rate, so over time, the small wins build up. The beauty of this approach is that, with discipline and execution, your wins will stack up and eventually outgrow the losses. The small wins allow you to compound a small account more steadily. Even with a negative risk-to-reward ratio, risk management remains crucial. Set strict stop losses and don't overexpose yourself to the market. This strategy works best when you're selective about the trades you take, only entering trades with a high chance of success based on technical analysis like key support and resistance levels. By prioritizing high-probability trades, you increase your win rate, ensuring that your small profits steadily compound, even though the risk is slightly higher per trade. Capitalize on small movements with scalping. Scalping can work particularly well with a negative risk-to-reward ratio since you're taking advantage of quick, small moves in the market. For example, you might risk 40 pips to gain 10 pips in a fast-moving market, but because you're in and out of trades quickly and more often, your account grows steadily. Compounding effect. The power of compounding small, consistent wins is often underestimated. As your account grows, even slightly increasing your lot size or risk amount can lead to larger profits, turning a small account into a much bigger one over time. Stay disciplined. Avoid emotional trading. This strategy requires emotional discipline. Losses will happen, but staying committed to the strategy will pay off in the long run. Trust the system. Negative risk to reward only works if you stay consistent and avoid making emotional decisions after a loss. Focus on executing the strategy repeatedly. Measure success over time, not trade by trade. Don't judge the strategy based on a single trade. The success comes from long-term results. Over a large sample of trades, the consistent small wins will begin to outweigh the losses. Measure your progress over weeks or months, not just a single trade. If you like the video, please subscribe for more tips and insights, as you can grow your account using this strategy. You can follow my journey and learn how to turn a small account into something much bigger. Stay tuned.